Picture this. Every time somebody asks an AI model to write their cover letter, plan their vacation, or debug their code, a rack of GPUs in some cavernous data center spins up and starts melting itself. And somebody has to keep those racks cool, powered, and upright. That somebody is Vertiv, ticker VRT. And in Q1 2026, they just delivered adjusted earnings of $1.17 per share against a forward EPS projection of exactly $1. That's a 17% beat. In a market where everyone's chasing the shiny GPU names, Vertiv is the hidden critical layer underneath all of it.
And Hudson, the magnitude here matters. Revenue came in at $2.65 billion, up 30% year over year. Adjusted operating margin hit 20.8%, a 430 basis point expansion. But the real signal is what management did afterward. They raised full-year 2026 guidance to a midpoint of $13.75 billion in revenue and $6.35 in adjusted EPS. That's 34% revenue growth and 51% EPS growth for the full year. Companies don't raise guidance after a beat of this size unless the order book is screaming at them.
Screaming is the word. Let's get into why this company is built for this exact moment.
Let's do it.
So what does Vertiv actually make? Think of it this way. If the NVIDIA GPU is the brain of the AI revolution, Vertiv is the electricity feeding that brain and the air conditioning keeping it from catching fire. They make uninterruptible power supplies, power distribution units, switchgear, precision air cooling, and increasingly, direct liquid cooling systems. Plus, remote monitoring software through their Vertiv Avascent platform. It's the picks and shovels play on AI, except the picks and shovels are 50-ton power modules and liquid cooling loops.
And the addressable market is expanding faster than almost any industrial category in the last decade. Hyperscalers are projected to spend north of $250 billion on data center infrastructure in 2026 alone. Roughly 30 to 40% of a data center's capital cost sits in exactly Vertiv's product categories. And as rack densities climb past 100 kilowatts, traditional air cooling simply fails. You cannot run a Blackwell-class rack on a chilled water loop designed for a 2018 workload. That transition to liquid cooling is not optional. It's physics.
Physics doesn't care about your quarterly budget cycle.
Exactly. And that's why the order intake keeps accelerating.
Okay, the origin story is actually one of my favorites. Vertiv traces its roots to 1946, Columbus, Ohio. A man named Ralph Liebert starts building what eventually becomes the world's first precision air conditioner, specifically designed to keep early computer rooms from overheating. Think about that. The thermal management problem that's driving Vertiv's business in 2026 is the exact same problem they started solving 80 years ago, just at 1,000 times the scale.
And the corporate lineage is important here. Liebert became part of Emerson Electric's network power division for decades, which is where a lot of the deep engineering expertise accumulated. In 2016, Platinum Equity acquired the business from Emerson and rebranded it as Vertiv. Then in February 2020, Vertiv went public through a SPAC transaction. So you have 80 years of thermal and power engineering heritage wrapped in a 6-year-old public company structure. That's part of why no startup can replicate this. You cannot speedrun 8 decades of qualification cycles with hyperscalers and telcos.
That's the moat. Institutional knowledge compounded over generations.
And embedded into every major data center footprint in North America. Let's talk about the CEO, because tenure matters in a CAPEX supercycle. Giordano Albertazzi has been CEO since January 1, 2023. Mechanical engineering degree from Polytechnic University of Milan, MBA from Stanford. He joined Emerson Network Power, Vertiv's predecessor, back in 1998. He ran EMEA operations, became president of the Americas in March 2022, was promoted to COO that October, and took the CEO chair 3 months later. 25 plus years inside this business.
And under him, the transformation is remarkable. When he took over, adjusted operating margins were around 13%. Today, we're sitting at 20.8% with a target above 22% for the full year. 4 consecutive quarters of 25% plus organic growth, 8 straight quarters of beating and raising guidance. This isn't a new CEO still learning the business. This is a 25-year operator who finally has the demand environment he was engineered for.
And that continuity is huge during an AI capex boom because the worst time to have a leadership transition is when you're tripling manufacturing capacity.
He's the right captain for this ship.
All right, the valuation question everyone's asking. Trailing PE is 80.86, forward PE is 47.49, price to sales is 11.4 times, price to book is 29.4 times, EV to EBITDA is 46.2 times. By any traditional industrial framework, these are eye-watering multiples.
Okay, but let's stress test that. Forward EPS projection is $6.35 for the full year, up 51%. If they hit that, and remember they've beaten guidance 8 quarters in a row, the forward PE compresses fast. And if 2027 comes in anywhere near another 30% EPS growth, you're looking at a stock trading around 30-something times 2-year forward earnings. For a company with 30% revenue growth, 40% ROE, and net leverage of 0.2 times, that's actually not unreasonable.
The counter-argument is that industrials historically trade at 12 to 18 times earnings. Vertiv is being priced like a software company, and the beta comes from perception. 2.05. This stock moves roughly twice the market on any given day. When AI sentiment turns, this name will not be defensive.
So it's a high-conviction, high-volatility sleeve of a portfolio, not a widows and orphans holding.
Position sized accordingly. Now the Q1 2026 numbers, line by line, revenue $2.65 billion, up 30% year over year from $2.36 billion. GAAP diluted EPS came in at 99 cents, up 136% from 42 cents a year ago. Adjusted EPS won at 7 cents against a forward EPS projection of $1. Adjusted operating profit $551 million, up 64%. Adjusted operating margin 20.8%, expansion of 430 basis points. GAAP operating profit $440 million, operating cash flow $767 million, up 153%, free cash flow $653 million.
The Americas segment is where my eyes popped out. $1.814 billion in sales, up 53% reported and 44% organic. 44% organic growth in a single segment. That is pure hyperscaler demand showing up in the P&L. This is not accounting magic. This is concrete being poured and steel going up and Vertiv equipment being bolted into racks.
Asia Pacific also held up well, $514 million, up 15% 12 organic. But we have to address the EMEA problem. That segment dropped to $321 million, down 20% reported, down 29% organic. That's a significant decline.
Is that the bear case starting to flash?
Management's explanation is project timing and a tough comparison to a very strong prior year period. They say the pipeline is intact and H2 should recover. I'd call that credible, but not yet verified. If Q2 EMEA organic is still negative double digits, the full-year guide starts to look at risk. But 1 quarter of lumpy European project timing against a backdrop of 44% Americas growth is not a thesis breaker yet.
The Americas are doing the heavy lifting. And honestly, that's where the AI money is.
For now, yes.
Let's zoom out on the revenue trajectory because it tells a story. Back in Q2 2024, quarterly revenue was $1.953 billion, then $2.74 billion in Q3, $2.346 billion in Q4. Q1 2025 stepped back to $2.36 billion, which is seasonal. Then Q2 2025 jumps to $2.638 billion, Q3 $2.676 billion, Q4 $2.880 billion, and now Q1 2026 at $2.650 billion. So you're looking at a business that's essentially rebased to a run rate somewhere around $2.7 billion a quarter and still climbing.
And the guide reflects that. $13.5 to $14 billion in revenue for the full year. Midpoint, $13.75 billion. That's 34% growth on top of a 2025 that already grew substantially. Adjusted EPS guided to $6.30 to $6.40 cents. Midpoint, $6.35, 51% growth. Adjusted operating profit, $3.40 to $3.26 billion. Adjusted free cash flow, $2.1 to $2.3 billion.
And critically, this guide was raised after the beat. Most companies beat and reiterate. Vertiv beat and raised. That's management telling the street, the back half is not a question mark. We can see the orders.
Which is consistent with the multi-year hyperscaler framework agreements that are already signed. They're not guessing. They're shipping what's already on the books. Margins and cash flow are where the quality of this business really shines. Adjusted operating margin 20.8% in Q1, up 430 basis points year over year. Full year target 22.8 to 23.8%. TTM gross margin 37.15, TTM operating 18.25, TTM net 14.37. And the operating leverage story is nowhere near finished. Every incremental dollar of revenue is coming in at very high contribution margin because the manufacturing footprint is already largely built.
And then cash flow. Operating cash flow in Q1 alone was $767 million, up 153%. Free cash flow $653 million in a single quarter. Full-year free cash flow guide is $2.1 to $2.3 billion. TTM OCF is already around $274 billion. TTM FCF $2.28 billion. That's a cash machine.
And that cash flow funds the balance sheet strength. Net leverage of 0.2 times, essentially debt-free on an operating basis. For a company growing 30% plus, that's a remarkable capital structure.
Clean balance sheet, expanding margins, exploding cash flow. Check, check, check. So speak to the balance sheet. Cash of $2.3 billion, total debt $2.9 billion, net debt just $600 million, leverage 0.2 times. Total assets $12.8 billion, total equity $4.2 billion, ROE 39.8%, current ratio 1.5. The question I have is, what are they doing with all this cash? Because they're clearly not returning much of it.
Correct. The annual dividend is 25 cents a share, yielding about 8 basis points. Payout ratio 6.3%. Buybacks have been minimal. Capital allocation is overwhelmingly tilted toward organic capacity expansion, new manufacturing lines, new liquid cooling facilities, new power module capacity. Given that they're supply constrained at certain product tiers, that is the correct answer.
Because returning cash when you could be taking market share in the biggest infrastructure build-out of our lifetime would be malpractice.
Agreed. The shareholder return is supposed to come through the earnings compound, not the dividend check. With ROE at nearly 40%, every dollar reinvested is generating outsized returns. That's the right playbook for this moment.
Save the buyback conversation for the cycle when growth normalizes. Right now, build.
Street sentiment is firmly on board. Of the 20 analysts covering the name, 17 have it at buy or strong buy. 2 hold, 1 strong sell. The average price target is $350, which is about 8.8% upside from the current $321.75. But the post-Q1 revisions are what matter. RBC $356, TD Cowen $347, Citigroup $353, Barclays $345, Morgan Stanley $350 all. Every one of those 5 maintained or raised their rating after earnings.
When Citi, Morgan Stanley, and Barclays all walk out the morning after earnings and raise their targets, that's a pretty clear read from the street. That's not analyst chatter drifting up slowly. That's a coordinated thumbs up from firms that talk to every institutional buyer on the planet.
And the forward EPS projection has moved into the $6.9 to $6.35 range, which is now actually clustered at or slightly below management's own raised guide. That tells you the sell side is not out over their skis. If anything, they may still be conservative given the beat and raise pattern.
Which means if Vertiv beats again in Q2, we'll see another round of target hikes.
That's the setup. The thesis is not broken yet, but the tape is aligned.
All right, bull case, and I'm going to enjoy this one. 5 catalysts. First, AI CapEx supercycle. Hyperscalers are spending more than $250 billion on data center infrastructure in 2026, and every single GPU that turns on needs Vertiv-style power and cooling before it boots. Second, the liquid cooling inflection. Once rack densities cross 100 kilowatts, air cooling physically cannot remove the heat. Vertiv's direct liquid cooling products command premium pricing and multi-year contracts. Third, the Americas backlog. 44% organic growth in a single quarter means the pipeline visibility is extraordinary. Fourth, the beat and raise track record. 8 consecutive quarters. Management has earned credibility. And fifth, the margin expansion is not done. We're at 20.8% adjusted operating margin, headed toward 22.8 to 23.8 for the full year, and there's no reason to think the ceiling is there.
Let me layer in on each. The CapEx supercycle is not evenly distributed. The top 5 hyperscalers are driving most of it, which is a strength today and a concentration risk tomorrow. The liquid cooling transition is real, but rivals like Eaton, Schneider Electric, and a host of specialist names are all trying to enter that space. Vertiv's lead is measured in years, not decades. The Americas' backlog is strong, but converts to revenue on a timeline controlled by construction cycles, which can slip. The beat-and-raise pattern is real and statistically significant. And margin expansion depends on holding input costs and avoiding a price war as supply catches up to demand.
All fair. But when every headwind you raise is essentially a deceleration argument, and the stock is already priced for deceleration at 47 times forward earnings, the asymmetry still favors ownership.
Bull case intact with eyes open. Bear case, my turn. 5 risks. First and most pressing, EMEA down 29% organic. Management says timing. If Q2 confirms that, fine. If Q2 shows further deterioration, the full-year guide is at real risk. Second, hyperscaler concentration. We estimate the top 5 customers represent 70% or more of America's orders. A single major customer pausing CapEx, delaying a campus, or shifting to in-house solutions would cascade through the numbers. Third, valuation risk. At 80 times trailing earnings, there is zero room for an execution miss. The stock has already moved from the 52-week low of $77.24 to $320.75 against a high of $325.25. A single guide down from here could produce a 30% drawdown almost instantly. Fourth, tariff exposure. A meaningful portion of manufacturing is in Asia. U.S. trade policy on electrical equipment has been unpredictable, and any escalation hits gross margins directly. Fifth, capacity ramp risk. Growing revenue 30+% requires hiring, tooling, qualifying new lines. Any delay constrains revenue recognition even if demand is there.
Okay, I'm going to push back without dismissing. On an 1 quarter of lumpy European project timing against 44% America's growth is noise until it isn't. On hyperscaler concentration, yes, it's real, but these are multi-year framework agreements with take-or-pay characteristics, not spot orders. On valuation, I grant the fragility at this multiple, which is exactly why you size the position for that. On tariffs, Vertiv has been navigating that environment for years and has been shifting manufacturing footprint accordingly. On capacity ramp, fair, but it's a high-class problem to have.
The bear case is credible enough to demand risk management. It's not credible enough to avoid the stock entirely. That's the honest synthesis.
Respect the risks, own the exposure, trim if EMEA stays broken.
All right, rivals table. Eaton trades at 2.8 times sales with 10% revenue growth. GE Vernova at 7.9 times sales with 21.5% growth. Amatec at 4.7 times with 4.8% growth. Hubble at 3.4 times sales with 5.9% growth. Vertiv sits at 11.4 times sales with 30.2% growth. That's a 44% premium to GE Vernova, the closest AI narrative rival, and several times the multiple of the slower-growing industrials.
And that premium is the argument. You're paying more, but you're getting 3 times the growth of Eaton, almost 50% more growth than GE Vernova, and dramatically higher margins and ROE than any of them. The PS ratio is not comparing the same businesses.
Agreed. But it does mean the stock carries the most reversion risk if growth slows. That's the trade-off.
Option sentiment confirms the bullish tape. Call premium of $4.06 million versus put premium of $612,000. That's 87% call weighted. Traders are aggressively positioned long, especially into upcoming catalysts. On the insider side, EVP Anders Karlborg sold 30,487 shares in the $245 to $249 range back in February. Context: that's routine diversification at significantly lower prices than today. Director Jockey Hausler received 5,578 options at $241.78 with 4-year vesting, which is a normal board grant, but it's a positive alignment signal.
Bottom line synthesis. Vertiv is the infrastructure layer of the AI build-out. It's growing 30% plus, expanding margins, generating over $2 billion in free cash flow, and sitting on a nearly debt-free balance sheet. Valuation is demanding. EMEA needs to stabilize. Hyperscaler concentration is real, but the combination of 44% America's organic growth, an 8-quarter beat-and-raise streak, and a CEO who has been inside this business for 25 years makes this one of the highest quality ways to own AI infrastructure exposure without taking single chip risk.
And I'd add, the CEO's own words on the Q1 call say it better than we can. The demand environment for critical digital infrastructure has never been stronger. Our customers are building at a pace we have never seen, and Vertiv is the infrastructure they cannot build without. That's the thesis in 2 sentences.
Before we close, the standard disclosure. Charged Alpha is for informational and educational purposes only. Nothing in this podcast is financial advice. All investments carry risk, including loss of principal. Nothing we've discussed should be construed as a recommendation to buy or sell any security. Do your own research and consult a licensed financial advisor before making investment decisions.
Thanks for spending part of your day with us. If you like this breakdown, come find us at chargedalpha.com for more deep dives, written research, and episodes across the names we follow. Until next time, stay curious, stay charged, and we'll see you on the next one.
Take care, everyone.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.